I'm very pleased to be here today. I was here last year and it was a very successful event, so I'm very glad to be back. Liquidnet is an institutional block trading firm. We facilitate and implement large investment decisions for institutions all over the world. We do this in the equities market. Equity market is our focus, is what I know, so that's very much what I will talk about today. There is a direct correlation when we talk about funding of SMEs. I mean, either you at some point go on to go public, and we all know that large multinational companies start from somewhere, and they need a framework to access that capital and to create growth. I want to talk to you about a few things. First of all, what is the important shape and form of equity markets, and why is it so crucial to funding long-term growth? I'm going to do a bit of a look back on recent years' development and how markets have developed in this area, why it's so important to talk about that specific thing right now, also how that can be changed perhaps to create a better framework for the future, and finally how regulation can play a very important role in that. So if we go back and look at equity markets, what is the function that equity markets should play in today's economy in terms of funding long-term growth? Well, we have two components here. We have the primary market and we have the secondary market. The primary market is very much where a company comes to raise capital in order to invest that capital to create future growth and future sustainability for that company. The flip side to that coin is obviously where investors can supply capital to these companies in terms of generate future returns. That is the very core function of equity markets in my mind. That is their raison d'être, if you like. Then alongside of this, we have the secondary market. The secondary market doesn't necessarily play a direct role in terms of fundraising, but it has a very important impact on the primary market in the way that the secondary market is where you continuously set prices for company. It's where you value company going forward. It's also where investors after an IPO can take part of that company's growth story. And it's a benchmark for a company to come back and raise more capital in the market via secondary offering, etc., what it may be. Now, who's driving these markets? Who's driving the primary and the secondary markets? Well, it's primarily driven by two types of investors. It's driven by institutional investors and it's driven by retail investors. That's a definition or a differentiation that we normally use, which I'm personally not that happy with. In my mind, institutional investors is simply a collective group of retail investors. If you look at institutions today, it's generally fund managers, pension fund managers, etc., etc. It's pooling of pension fund money or people's savings. It's a large group of retail investors. So when talking about who's driving markets, I would look at it all the same. It's retail investors either directly or via an institutional offering. Now, why is this so important for retail investors? It has a very direct impact. If you look in Europe and you look at the average citizen and you take a look at their net worth, and of that net worth, what is the exposure to equities markets? If you look at the direct investments I do on a retail account, an online account, buying into equities or shares, it's just under 10%, 8 or 9%, give or take. If you, however, include the exposure they have through either their pension plan or their mutual fund savings, this number goes up to around 40%. So 40% of the average European citizen's net worth is directly exposed to European or global equity markets. To me, that makes it a very, very extremely important point for the average European investor. Now, if we then take a look at equity markets over the past few years and have a view on the kind of changes or the cycle we've gone through, on many ways, on many levels, it's an encouraging development. So what we've seen is what used to be very much defined as a long-term investors market has increasingly become a market for short-term speculation, increasingly become a market, a trader's market rather than an investor's market. We talk about things such as short-term speculation, trading based on a disassociation of the fundamental value or the underlying value of the company compared to the prices in the market, People mention casinos, etc., etc. That might be a bit extreme, but the fact remains the same. Holding periods has gone down dramatically. More and more of the volume we see in European equity markets is based, less and less of the volume we see is based on long-term investment and value fundamentals of companies, and more is based on market making, short-term speculation. Now, why is that dangerous? Why is that an issue in the secondary market? Well, it is an issue because the secondary market has such a direct correlation to what is driving the primary market. So if we have a secondary market which has volatility spikes which is not directly correlated to fundamental values of companies, if we have technology glitches that makes investors lose money overnight, which is unexplainable in terms of valuation and fundamentals, what it means, it reduces investor confidence, it reduces the average investor's belief in long-term sustainability of equity markets. Effectively, it means that everyone in this room will most likely put less and less money into equity markets. At the same time, the flip side of that is that we will see less companies go to the primary market to raise capital. We will see less companies seeking long-term funding through equity markets, which is a fundamental issue because it's exactly the opposite of what we want to achieve, how we want markets to work. I'm going to give you some examples. These are US examples, but they're nevertheless extremely relevant on a global basis. If we look at Intel, 1971, Intel went public at a valuation around $100 million. Today, Intel is worth over $100 billion. If we look at Microsoft, Microsoft went public in 1986. It did so on a valuation of around $500 million. Today, Microsoft is valued around $250 billion. A more recent example is Amazon. Amazon went public in 1997 at a valuation around $400 million. Today, Amazon as well is worth over $100 billion. Now, this proves that the model worked. This is exactly the type of markets we want to promote in order to achieve long-term growth for company, but also real return for investors. Now, this is some years ago. If we look at some more recent events, we have the famous Facebook IPO. Now, Facebook went public at a valuation of around $100 billion, and it never traded higher than the first day it was listed. What that tells you is the growth of that company, the wealth creation, took place before the IPO and not after the IPO. So the average investor, the average retail or institutional investor, did not take part in that wealth creation, in that growth creation. There was undeniably a growth creation happening, but that benefited more the founders and the owners of the company that wanted to cash out than the people, the investors who were willing to fund the long-term growth of the company. We do have another recent example, which is very much in the making at the moment, which is Twitter, which is looking at going public at a valuation around $15 billion. Again, very, very high for a company to go public at. Now, this in isolation is an issue, but putting it into the time frame we are right now, in terms of Europe being on the verge of turning around, we see more and more investment coming into Europe, we see equity markets picking up in Europe, the timing couldn't be worse. Because what it means is the institutional investors had never had a harder time to efficiently put their money to work in the equity markets than today. If you go back over the past 30 years, the average institution, their asset under management in equities has grown 40 times in value. Now, if you put that into a market structure which becomes increasingly difficult to invest in, you have a problem which is a supply and demand problem. Every time a large institution goes to market, they will create a market impact that is extremely detrimental to the future return of what they're trying to achieve. On average, and we've done some research via a third-party firm called Liquid Metrics, looking at the type of trading we do for institutions. On average, if you cannot use an efficient way of implementing your investment strategy, market impact that you're going to suffer is around 100 basis points. Now, that's around 1%. If you look at a fund trying to achieve an average of 5% yearly return, and it's going to cost you 1% simply to get in and out of those positions, you're 2% down before you're even started. So it is a real issue. It's a market structure that effectively created a tax on future returns simply because it's so hard to implement the investment decision. Now, there's a good point to this, and the good point is that this is something we can change. We've created this environment, and we can create a different environment for the future. And I think this is where regulation becomes extremely important. Regulation and policy making can create a much better framework for the future. Now, I think bearing in mind when talking about regulation is, in my mind, it's somewhat of a double-edged sword. On one side, you can put some very positive legislation in place that can drive a positive evolvement, or you can create some unintended consequences. And we've all seen what some of those unintended consequences might have been in terms of the adoption of MiFID I. Now, when we're looking at the type of legislation that we would like to see being created, being suggested, being agreed on in the trilogues that we see at this moment, I guess to some extent we would very much favor a back-to-basic approach. Let's keep in mind the very end goal that we're trying to achieve here. This is things such as end investor protection, minimizing systemic risk, creating a framework of transparency, but nevertheless alternative execution for firms that need that in order to implement their investment decisions. Those are the things that we would encourage regulators, policymakers, politicians to think very, very hard about when we go through these negotiations. And also, at this time, I think this becomes increasingly important, because if it's one thing that we see amongst our members, the institutions that we trade for, there are about 750 of them over 5 continents, is that more and more people today, almost everyone, are looking at investments on a global basis. And I'm not talking about someone creating an emerging markets fund to gain exposure to South America or India. I'm talking about active asset managers that are looking at similar investment decisions on a global basis, but they look at P evaluations, etc., but they also look at how easy is it to implement my investment decision in this market, access to liquidity, and what is the regulatory structure, the regulatory framework. And the last thing we want to do, as we want capital to flow back into Europe to keep fuel long-term growth, is to create regulatory barriers. Thank you very much.